Every year, roughly 5 million S-Corp returns land on desks at the IRS. The overall audit rate for those returns sits at approximately 0.4 to 0.5%. That number is so low it sounds like permission. It is not permission, it is a filter. And the filter is not random. The IRS does not audit S-corporations the way it audits individual returns. It targets a specific profile. A single-owner S-Corp reporting net income above $100,000 on Schedule E, while paying the officer a W-2 salary that falls below 50% of the industry median. Based on IRS statistics of income enforcement patterns and practitioner analysis, the examination rate for that specific profile is significantly higher than the headline number, with estimates in the range of 2 to 4% depending on the income bracket and the size of the salary to distribution gap. And when those audits close, the average reclassification assessment runs in the range of $15,000 to $25,000. Once you add the back FICA taxes, the accuracy-related penalty, and the interest. According to one detailed calculation published by STIO CPAs, a reclassification on $100,000 of distributions can generate approximately $15,300 in employment taxes, $3,060 in penalties, plus accumulating interest. That is the math nobody puts in the TikTok. So here is the question. You formed an S-Corp because someone on the internet told you it would save you thousands. Did anyone tell you what happens if the IRS disagrees with the salary you chose? This is not speculation. This is published data, court records, and enforcement patterns. The S-Corp is not a bad structure, but it has a fuse, and the fuse is the number on your W-2. Start with a person in Tampa, 34 years old, freelance graphic designer. Annual revenue, around $130,000. Last year, this person watched a YouTube video that said forming an S-Corp would save them $8,000 to $12,000 a year in self-employment tax. They filed the paperwork, elected S-Corp status, set their own W-2 salary at $45,000. The remaining $85,000 came through as shareholder distributions, which are not subject to FICA. On paper, the tax savings looked like this. As a sole proprietor, this person owed self-employment tax on 92.35% of their net income. According to the IRS, the self-employment tax rate is 15.3%. That is 130,000 times 0.9235, roughly 120,000. Apply the 15.3% rate, that is about $18,360. In self-employment tax. Under the S-Corp structure, they only paid FICA on the $45,000 salary. The employer and employee shares combined at 15.3%. Comes to $6,885. The savings on paper, about $11,475. That number is real. It is also the number the IRS uses as the starting point for its reclassification calculation, when it determines the salary was too low. The Bureau of Labor Statistics reports the median annual wage for graphic designers was $61,300 as of May 2024. The top 25% earned $79,000. This person earns $130,000 in gross revenue. They set their salary at $45,000. That is 26% below the national median for someone doing the same job. Without running the business, and this person does run the business. They handle client acquisition, project management, invoicing, creative direction. The IRS has a multi-factor test for reasonable compensation. Outlined in Fact Sheet FS-2008, -25. One factor is duties and responsibilities. Another is time and effort devoted to the business. Another is comparable wages paid in comparable businesses. Nobody talks about that fact sheet on social media. Everyone shares the savings calculator. The first hidden risk is the one that just landed. The salary is too low. Not by opinion, by the IRS's own published benchmarks and the court precedents that enforce them. In Watson v. United States, the Eighth Circuit Court of Appeals ruled that a CPA, who paid himself $24,000 a year from his S-Corp, while earning significantly more in distributions, was not paying reasonable compensation. The court accepted the IRS expert's determination. That reasonable compensation was approximately $91,000. The difference was reclassified as wages. FICA taxes were assessed retroactively on that amount, plus penalties and interest. The graphic designer in Tampa set their salary at $45,000. If the IRS applied the same logic and the BLS data, the fact sheet factors, and the Watson precedent all point in the same direction, the reclassified amount could be somewhere between $20,000 and $40,000. FICA, on a $30,000 reclassification alone, comes to $4,590. Add the accuracy-related penalty at 20% on the underpayment. Add interest running from the original due date. The bill starts approaching the entire amount this person thought they saved. Nobody puts that in the YouTube thumbnail either. The second hidden risk is the compliance cost that nobody mentions. When they say just form an S-Corp, a sole proprietor files a Schedule C, an S-Corp files Form 1120S, runs a W-2 payroll, files quarterly 941S, and needs bookkeeping that separates officer compensation from distributions. According to WCG CPAs, a firm specializing in S-Corporation advisory, the baseline annual compliance cost for operating an S-Corp, including bookkeeping, accounting, payroll service, and tax preparation, starts at approximately $3,000 per year for their basic package. The S-Corp tax return preparation alone ranges from $800 to $3,000. Depending on complexity, according to tax experts of OC, a sole proprietor's Schedule C preparation costs a fraction of that. These are not one-time costs, these are every single year. Go back to the graphic designer. Estimated self-employment tax savings, $11,475. Subtract the additional compliance costs, conservatively $3,000 a year. Net savings before any IRS scrutiny, about $8,475. Still a good number until you get to the third risk. These numbers come from official sources. They are not a prescription. Consult a licensed CPA or enrolled agent before applying any of this to your specific situation, but the math keeps going. And the next layer is the one that matters most. The third hidden risk, and this is the one that should have been on slide 1 of every S-Corp explainer video, is the IRS enforcement trajectory. The Inflation Reduction Act of 2022 allocated approximately $80 billion in additional funding to the IRS, with a substantial portion earmarked for enforcement. The IRS has publicly stated its intention to increase audit rates on high-income individuals and business entities. In fiscal year 2024, according to a TIGTA report released in 2025, high-income audits made up 17% of all individual audit starts, nearly 2.5 times the average of the prior 5 years. S-Corporation reasonable compensation is not a complex audit target. The IRS does not need forensic accountants to spot the gap. A computer can compare the W-2 salary on the 1120S to the BLS median for the reported industry code. If the salary is less than half the median and the net income is 6 figures, the return gets flagged. The algorithm does not care about the TikTok video. 505,000. That is the number of tax return audits the IRS closed in fiscal year 2024. According to the IRS data book, the agency is hiring, the funding is in place. The targeting algorithms are getting more precise. And S-Corp reasonable compensation is one of the easiest, most quantifiable audit targets in the entire tax code. It requires no interpretation of law. The law is settled. Watson settled it. The only question is the number. IRS Statistics of Income Data from 2017, compiled by WCG CPAs, shows that for S corporations with gross receipts between $100,000 and $250,000, average officer compensation was $24,405. Average net income for that bracket was $24,796. Officer compensation as a share of total earnings. Once compensation is added back to net income, was approximately 50%. For the professional and scientific services sector specifically, that figure was 52%. That means even the IRS's own dataset shows officers in that revenue bracket, paying themselves roughly half of total earnings. An owner paying themselves 34% of their net income, which is what $45,000 on $130,000 looks like, is below the floor the IRS's own statistics establish. Strip away the acronyms and the tax code sections, and what you have is a person who saved $11,000 and exposed themselves to a $23,000 liability. The difference is $12,000 in the wrong direction. That is the whole story. Now here is where the conventional wisdom falls apart completely. The popular advice is to use a 60-40 split. 60% salary, 40% distributions, or 50-50. There is no such rule in the tax code. The IRS fact sheet on wage compensation for S-corporation officers does not mention any percentage split. Courts have never upheld a fixed ratio as a safe harbor. Every case, Watson, Ratke, Spicer, was decided on the specific facts, what the person did, what the market would pay for that work, and how much they actually took as salary. A percentage is not a defense. A compensation study is a defense. The person who told you 60-40 is fine did not offer to pay your audit bill. Your monthly payment to the payroll service is $49. The quarterly 941 filing costs you nothing if you use the software. The CPA charges $2,000 for the 1120S. The IRS reclassifies $35,000 of your distributions. FICA on that, $5,355. Accuracy-related penalty, $1,071. Interest from the original due date, compounding daily, call it another $800. Professional representation to negotiate with the IRS, $3,000 to $5,000. Total exposure, $10,226 on the low end. Not counting the time, the stress, and the amended returns you now have to file. For context, the savings this person was chasing were about $8,000 a year after compliance costs. One audit wipes out more than a full year of savings, and the audit can cover multiple tax years, which multiplies everything. You scroll past it at 11 at night. Someone in a ring light explaining how they saved $10,000 with one form. The comments say, life-changing. Nobody in the comments mentions the fact sheet. Nobody mentions Watson. Nobody mentions that the IRS publishes the median salary for your exact job in your exact city, and your W-2 better not be half of it. That is not a failure of information. It is a failure of incentives. The person making the video gets paid when you watch. The person filing the election gets paid when you incorporate. Your payroll provider gets paid monthly. Your CPA gets paid annually. Every person in the chain between you and the S-Corp election earns revenue from the formation. Nobody in that chain earns revenue from telling you to wait, to model the risk, or to pay yourself more. Your W-2 salary is $49 a month in payroll fees. Your distributions are free. The IRS does not see free. The IRS sees a gap. And the gap is the entire audit. There is no urgency to undo anything. But there are 3 levers that exist in the system right now, and each one is documentable. I am not telling you to do any of these things, but here is what the system makes available. Lever 1. Run a reasonable compensation analysis, not a percentage, an analysis. Pull the BLS occupational employment and wage statistics for your specific SOCI code in your specific metro area. Compare the median, the 75th percentile, and the 90th percentile to your current W-2. Document the comparison in writing, date it, save it with your tax return. If the IRS ever sends letter 2205B, that document is the first thing your CPA hands to the examiner. Lever 2. Recalculate whether the S-Corp election even produces net savings. At your income level, after compliance cost, after the risk-adjusted cost of audit exposure, and after the Social Security benefit reduction. That comes from lowering your W-2 wages. The Social Security wage base for 2026 is $184,500, according to the Social Security Administration. Every dollar you do not pay yourself as W-2 wages is a dollar that does not count toward your Social Security earnings record. That is a retirement benefit trade-off that no short-form video has time to explain. Lever 3. If you already have the S-Corp, set the salary at or above the BLS median for your role and location. For a graphic designer, that is $61,300 nationally. In a higher-cost metro, it could be $70,000 or more. Yes, this reduces your annual FICA savings. It also reduces your audit exposure from a potential $23,000 bill to effectively zero. The math on that trade-off is not close. The S-Corp is not a trick, it is not a scam. It is a legitimate tax structure with a legitimate benefit and a legitimate compliance requirement. The problem is that the benefit gets a highlight reel, and the compliance requirement gets a footnote. The fact sheet is not a footnote. Watson v. United States is not a footnote. The IRS enforcement budget is not a footnote. You are not behind because you formed the wrong entity. You are behind because the advice you followed skipped the page where the cost was printed.